Hey guys, welcome back. To those of you that are taking any of the FINRA exams, we're going to talk in this video about annuities, a topic on the exam which can be very difficult for you, especially if you don't have a broad background in the insurance industry. The Series 65 exam, which is the one I'm taking just for fun, preps people to become an investment advisor if they wanted to. And there are a broad amount of securities and investing topics on the test. The knowledge tested on the Series 65 exam covers a broad segment of investment knowledge, including economic factors and business information, investment vehicle characteristics, client investment recommendations and strategies, and your understanding of laws, regulations, and guidelines. We are going to be talking about one small subtopic in category number 2, the investment vehicle characteristics. It goes through fixed income securities, all sorts of bonds, the different types of equity securities, characteristics of them, public offerings, types of pooled investments, hedge funds, venture capital, derivative securities, options, and one little section that we're going to be talking about today, because it is so difficult unless you're in the insurance industry and have some previous experience with this, is the section on annuities, variable annuities, fixed annuities, and indexed annuities. I use Achievable as my online test prep resource. There is a link to it down in the video description if you want to sign up and try out Achievable yourself. I highly recommend it. They have an online textbook, online community, all sorts of online quizzes, which we might do at the end of this video on annuities, and all sorts of checkpoint, midpoint, and final exams, all to prep you to go take the official exam at the testing center. If you have previously taken the Series 65 or any of the other exams and did not pass, and you're looking for a better tool to help you prep for these tests, then click on that link down in the video description, check out Achievable, and then afterwards let me know how it went for you. What I want to go through with you today is just sharing my test prep with you. I've got some slides here talking about annuities. I read through the textbook on Achievable. I took the online quiz. I'm not familiar with insurance products, even though it's a niche in this whole category we call securities, or things that you might have to advise people on. It's something that you will be tested on. And even if it's only a couple questions, I don't want to get them wrong if I can just memorize the information. But I read through the textbook. It is very complicated information for someone like me that doesn't have a long history in insurance products, no history in it. And so I did not do well on the quiz. Then watched some videos that are available out there on YouTube. And then I wrote up my written test prep, things that I want to remember to make sure this is straight in my head. And that is this slide deck that you see on the screen. We're going to go through it so you can kind of see how I compartmentalized things. And if you are struggling with annuities and you're watching videos, maybe this one will be helpful to you. There is no getting around the fact that becoming a subject matter expert on annuities, to the extent that you get the questions right on the exam, there's no getting around that you're going to have to memorize stuff. But in order to memorize stuff, you're going to have to come up with some way to compartmentalize and understand the information. Under annuities, there are categories and then subcategories, and then under those subcategories, there's different tax treatments and different rules, and it becomes this tree with many branches. And when you take the test, you're going to have to remember the differences between one or the other, because they're going to try and trip you up comparing different types of annuities, or they'll give you a test question and say, which one of these does not apply? Which of these is true? All the different ways that they try and trick you. So it is going to require some memorization. Let's go through how I compartmentalized my different tree branches. The basic definition of an annuity: a financial contract between an individual, which we call the annuitant, and an insurance company designed to provide a stream of income payments and typically used for retirement planning. Underneath that, we have these subcategories. And the first one to think about and get straight in your head and be able to compare and contrast are non-qualified annuities and qualified annuities. And the basic difference between them is how they are funded. And so I have that underlined here. Non-qualified annuities are funded with after-tax dollars. Your job pays you. You have tax withholding. You have fully funded your 401k, and you've got money set aside in a savings account, and you've got extra money and you're wanting to invest that for retirement. Maybe an annuity is something that you want to consider after all of those other things are taken care of. After-tax dollars. It is not held within a tax-advantaged retirement plan like your 401k. Make sure you're loading up those 401ks first would be my first thought. But if you got extra money, then you could look at a non-qualified annuity. By contrast, a qualified annuity is funded with pre-tax dollars held within a tax-advantaged retirement plan, such as your IRA, 401k, or 403b. So just remember, non-qualified after tax, qualified pre-tax dollars, how you fund the account. The additional notes that I put down there for myself is that the difference between the two impacts the final result in terms of taxation, contribution limits, and suitability for clients. And just a reminder that the Series 65 exam is more likely to focus on non-qualified annuities, although you might get some test questions about qualified annuities as well. Once you understand how the annuity is going to be funded with pre-tax or after-tax dollars, the next category or selection that you're going to need to think about and understand the difference between is the types of annuities that you could choose from or your clients could choose from. And those two broad categories are variable annuities and fixed annuities. Important to remember that for both of these, it is tax-deferred returns, tax-deferred growth that they have in common. But where they differ is how the money is invested. A variable annuity is tied to the performance of underlying investment sub-accounts, typically mutual funds, that the investor chooses. And so the payments and the account value can fluctuate, hence the word variable, with market performance. A fixed annuity, on the other hand, has a guaranteed rate of return set by the insurance company with payments during the benefit period that do not fluctuate based on market performance. Why is that important to understand? Because if it is variable and you are directing where the investment goes during your contribution period, then that variable annuity, all of them, are considered securities because you are subject to market risk. You're investing in mutual funds and those funds could go up or down. Variable annuities are regulated as securities. Fixed annuities, having more of what we might consider a guaranteed return, are not considered securities because the payment is fixed and the investor does not have any discretion to choose the investment vehicles that those contributions are invested in. The insurance company will pick where to invest your money if you chose a fixed annuity. Besides remembering that a variable annuity is a security and a fixed annuity is not, remember that a variable annuity exposes the investor to market risk, whereas a fixed annuity does not. Another key difference between variable and fixed is this last bullet item, number 2, the M&E charges, the mortality and expense charges. A variable annuity could be subject to M&E charges, whereas a fixed annuity is not subject to M&E charges. I don't know if we'll get into what those are exactly in this video or not, but I'm mainly doing my test prep here live with you guys, showing you what I'm writing down to remember. And I think the important thing to remember is that a variable annuity is subject to M&E charges and a fixed annuity is not. All right, let's go down one more branch on the tree, another subcategory to think about here. We're now just going to think about variable annuities. And the two broad types of variable annuities being an immediate annuity and a deferred annuity. Imagine you won the lottery and you have a huge amount of money, or you got an inheritance and you got a huge amount of money and you want to set up an annuity. That would be maybe a situation where you want to consider an immediate annuity. It is one that is funded with a single lump sum payment. They are less common because due to the large lump sum needed, not everybody qualifies for an immediate annuity. More common would be the second one highlighted in purple here, a deferred annuity. Maybe, something that you think of as more traditional, where you contribute to it for many years or decades over time during the accumulation phase, and it will have either variable or fixed premiums. So there is likely to be more questions on deferred annuities, but you should understand what an immediate annuity is as well. You contribute money on an immediate, and then you're able to take it out. On a deferred, you contribute money, and then at some point in the future, you decide to take that money out. We talked about this briefly in a previous slide, but I want to hammer home a couple of the key features of a variable annuity. When we think of the words variable annuity, we must be able to recall some very important features of variable annuities. Number one, variable annuities are placed in a separate account at the insurance company versus the general account. Remember that variable annuities are placed in a separate account or a sub-account. You might also see it categorized as. Same thing. In that separate account, you as the investor or your client as the investor makes the decision where to invest that money. And so they are subject to market risk. Number three, it's called a variable account because the rate of return or the account growth will vary with the market. Number four, variable annuities are considered a security since the market risk exists. I know I'm repeating myself on some of these, but these are important concepts to have memorized. And what is the key risk of a investor, a client who is invested in a variable annuity? The key risk for the investor is market risk. You're invested in mutual funds. That return and the growth of your account is going to vary over time. That is the risk, market risk. Once you have decided where your funds are going to come from to fund this annuity, qualified or non-qualified, and once you have decided if you're going to pick a fixed annuity or a variable annuity, and once you've decided if that variable annuity is going to be immediate or deferred, the next branch down to think about is the different phases of that variable annuity. And those two phases are broken down into what we call the accumulation phase and the distribution phase. A couple of important things to remember about these two different phases. The accumulation phase is the period of time when your money is contributed to the account. That's pretty straightforward, right? It could be one day, and if it was an immediate annuity, or it could be over many years if it was a deferred annuity. The money, as we said, with a variable annuity is placed in a separate account during the accumulation phase, and the investor dictates where that money is invested. One other thing to remember about the accumulation phase is that most annuities offer what is called a death benefit. The death benefit typically only exists in the accumulation phase. It would kick in if the account owner died before annuitizing the contract. We'll get to annuitizing in a minute, but just remember that a death benefit is something that can happen in the accumulation phase. What happens if that account owner dies is that whoever your designated beneficiary is would receive a payout, and that payout, there's something else you're going to need to remember. It's going to be the greater of the account owner's basis or the current value of the account. Why do we have two different numbers there? The basis is what the account owner has been contributing, and the current value could be more or less than that amount. depending on the market performance of that investment. And so if the account holder were to die, the beneficiary would get the greater of those two numbers. If the investor had invested $100,000 and the account was worth $200,000 because it's been in existence for many years and it's had phenomenal growth, the death benefit would pay out $200,000. If, on the other hand, the investments weren't doing so well and the account was only worth $80,000, we're going to get the greater of the two, and you would get the basis back, the full $100,000. So let's move on to the next phase. You've done all your years of accumulation and you want to move into the distribution phase. That is the time period when the investor could take payments from the annuity. And those payments can be, here's some more branches: lump sum, random, systematic, or annuitized. I think, most of these definitions are fairly straightforward. A lump sum withdrawal is obviously you're going to empty out your account. Your annuity is not going to pay you for the rest of your life because you took a lump sum withdrawal. A random withdrawal means that from time to time you take out random amounts, and you do not get an annuity that pays you out for the rest of your life because you chose random. Systematic withdrawal, also not guaranteed for life. Similar to random, but it's a more systematic distribution. Or you could tell the insurance company that you want to annuitize your account. You want a predefined benefit based on the amount of money that your account is worth. And if you annuitize it, then that payment will be guaranteed for life, whether you live another 3 months or another 40 years. Obviously, when you annuitize it, the payment that you receive is going to be dependent on actuary tables and how much money that you have invested and how much that money has grown to. But no matter how long you live, you will get a payment for life, even if it exceeds the value of your account. That money is guaranteed for life. Thinking about the next branch down, about that annuitized payment, we need to understand what is a assumed interest rate, or AIR, AIR for short. After you elect to annuitize your annuity, AIR is the assumed interest rate used to calculate the variable annuity payments during the distribution phase. It acts as a benchmark for the sub-account performance. I don't want you to get too far in the weeds worrying about this, other than understanding that a assumed interest rate is set by the insurer at the contract initiation. And if your account growth during the distribution phase every month is greater than the AIR, your payout, your variable payout, will go up. And if your account growth during the month is less than the AIR, then your payout for the next month would decrease. And I put a little table here down at the bottom to kind of give you an example of what we're talking about here. We're going to assume an AIR of 4% and that the investment was worth $100,000, and we've annuitized it and we're getting our first payment in January. Our first payment is $333. And then the performance during the month of January of our money, it earned 6%. I'm making up a number. Any number greater than 4%, the AIR. We would see then the next month in February that the variable payment would go up. That is because the account performance was higher than the AIR. In February, let's say the account performed at 5%, still higher than 4%, still higher than the AIR. So our payment goes up again in March. We get more. In March, though, the performance of the account is equal to the AIR, 4%. That means the next month in April, our payment stays the same as March. It doesn't go down, it stays the same as March because the AIR matched the account performance in March. But in the month of April, the total performance of the account was 3.7%. Now that monthly performance is less than the AIR, so our May payment is going to go down relative to April. Hopefully that makes sense to you. If not, listen to this section of the video again and think about it. Go do a little more reading. All right, are y'all ready to go down one more set of branches? Once we've decided to annuitize our variable annuity, the next choice we have to make is what option do we want to annuitize the payout? We got 4 of them listed on the screen, and the order matters here for a reason we'll get to at the end of this slide. But the first and most basic is a straight life annuitization. That pays you or the investor for life, and it assumes that there is no beneficiary. That is the highest payout. The second option would be life with period certain, it is called. That also pays for life with a guarantee of a period certain. For example, 10 years. There's going to be different period certains out there, but for this video, we're going to just talk about an example of a 10-year period certain. Payments would continue for your beneficiary if you were to die early. So you annuitize your annuity, you're getting your payments, you've got a life with period certain guaranteeing 10 years of payouts, but you die after 2 years. If you had elected straight life, it's over. It's over at 2 years. If you have life with period certain, you might die after 2 years, but your beneficiary would continue to get payments for an additional 8 years, a total of 10 years, including however many years you lived plus however many years were left over up to the end of the period certain. Because there is more risk for the insurer that they might have to pay more, the life with period certain is less of a monthly payout than straight life. So let's move down to the one which pays the next lower amount. Joint and last survivor. More flexibility, lower payment per month. Joint and last survivor pays 2 account owners until both pass away. So let's think of an example where we're looking at a husband and wife. The annuity is going to pay out until both of them die. Not just when one dies, not just for a guaranteed period, but as long as it takes for both the joint and the last survivor to pass away. And because that time is harder to define, this one is going to pay out a little bit less than number 2 and less for sure than number 1. The final one, which is less common, but it might come up on the test, is a unit refund, which pays for life, but it refunds the beneficiary if the account owner passes away prior to getting a payout for their basis. So rather than thinking about a set number of years, let's think about someone who contributed $100,000, their account grew to $200,000, and they're getting their annuity payments, but they pass away before they collected $100,000, their basis. The beneficiary would get a payment for the remaining amount of the basis that has not been paid out yet. The other important thing besides just keeping these straight in your head and how they function is the order is important. As it says in the note at the bottom of the screen, the above options are listed from the highest to lowest in payout benefit to the annuity holder. Straight life is going to pay out the most. Life with period certain pays out the next, but a little bit less. Joint and last survivor of those 3 pays the least. And then if unit refund were included, that would be your lowest payment. We've been talking a lot about variable annuities. Let's climb back up the tree to one of those top branches and talk about the other branch besides variable, and that is fixed annuities. And this is going to be quick and simple. The things to remember about a fixed annuity is it is not a security, as the payment is fixed and you have no market risk as the annuity holder. The assets that are contributed to a fixed annuity by the investor are placed in a general account, which is controlled by the insurance company. Remember, a variable annuity is placed in a separate account. Fixed annuities are placed in a general account. The insurance company directs the allocation of that investment, and they are typically going to pick a safe investment, and your payout on a fixed annuity is going to be typically less than on a variable annuity. And since that payment is lower and it is fixed, there is one risk related to fixed annuities that you must have clear in your mind, and that is that the account holder is subject to inflation risk. Remember, if your payment is fixed for the remainder of time and inflation is going up, then you are losing purchasing power. So you have inflation risk with fixed annuities. Once I had all of those branches straight in my head, the next thing that I turned to focus on is the tax considerations of these different types of annuities. And we're going back to the very top branch and thinking about the tax consequences of a non-qualified annuity versus a qualified annuity. Non-qualified, remember, is funded with after-tax dollars, and a qualified annuity is funded with pre-tax dollars. So when you get a distribution, the taxation on that distribution is going to be handled differently. On a non-qualified annuity, number 1B, the growth part of your account is taxable as ordinary income. The basis, which is the money you contributed out of your pocket, is tax-free on any distribution. However, the money comes out on a LIFO basis, last in, first out. So the growth, the part that is taxable as ordinary income, that is what is going to come out first. And at the very end of your distribution, however many years that takes, that is when you will get the tax-free distribution. So as you're thinking about tax planning, remember with a non-qualified annuity that the growth is taxable as ordinary income, and that is what is going to come out first in the distribution. For accounts that have been annuitized, when we're thinking about those payments for life, the withdrawals for the basis and the growth are now on a annuitized annuity, distributed simultaneously and taxed on a pro rata basis. I told you this was going to get complicated. Let's move on to a qualified annuity. Remember, funded with pre-tax dollars, so the taxation on withdrawals is going to be handled a little bit differently. All distributions now are going to be taxed as ordinary income. Both the money you contributed as your basis and the growth of that account over time. It was pre-tax dollars, now you got to pay the tax on it all. Another little tricky thing that you might be tested on is you must remember that qualified annuities are subject to required minimum distribution at age 73. And a final note on that, the failure to take a required minimum distribution can result in a 25% penalty on the amount not withdrawn. Number 3 on here, the final thing that I want to remember for myself and hopefully for you regarding tax considerations is the penalty for early withdrawal. And that is that 10% penalty if withdrawals begin before age 59 and a half. However, like many things in life, there are exceptions, more little tree branches here under our tax considerations. For non-qualified annuities, the 10% penalty that applies before age 59 and a half only applies to the earnings portion, not the basis portion. And for a qualified annuity, the penalty applies to the entire amount, both basis and growth, unless the annuity holder is subject to some exception under IRS laws. There are several exceptions. That's not really important for the purposes of this video. 2 last slides, things to think about and remember for annuities. There exists something called surrender charges. These are fees that you might have to pay if you withdraw money from your annuity before a certain period, usually called the surrender period, defined by your insurer. It is designed to discourage early withdrawals and helps the insurance company manage or recover its costs. Make sure to check the terms of the annuity for any surrender charges. In most circumstances, insurance companies impose surrender charges with periods of at least 5 years, if not 10 years or more. And our final little bullet point, which you might want to try and memorize, is that most annuities allow 10% free annual withdrawals, and the charges decrease over time. Surrender charges apply to deferred annuities, not immediate annuities. 3 or 4 things there to get straight in your head about surrender charges. The final slide on annuities is just a recap of the risks and who bears them, because there's going to be a variety of potential questions that you might come across talking about risks of annuities, and you need to understand who has the risk: the insurance company issuing the annuity or the account holder purchasing the annuity. The insurance company risks are three: mortality risk, expense risk, and longevity risk. The mortality risk is the risk that the investor dies earlier than expected. That's a risk because it would trigger a death benefit. The insurance company having to pay out money sooner than it was expecting to presents a risk to the insurance company. That is called mortality risk. Expense risk: the business expenses of running the insurance company could increase over time due to inflation or a lot of other different things. So that is something the insurance company needs to think about. Remember, we talked at the very beginning of this video about M&E charges. This is what they charge clients on variable annuities to mitigate their risk for mortality risk and expense risk. The final risk is longevity risk. That is the risk that an investor might live longer than an actuary table might tell them. However, they are counting on the rule of large numbers to mitigate that risk. They're going to have some people that pass away early and some that live much longer than expected. And if they are good at doing their business, the insurance company will manage that risk appropriately through the use of actuary tables. Which risks are important for the investor to think about? Inflation risk, we talked about that with fixed annuities, is something that you might want to keep in mind, that the monthly benefit might not keep up with inflation over a period of many years. Market risk, if you are talking about a variable annuity, the investor directing that investment contribution and the growth or the rate of return of that annuity is dependent on what investments were selected by the investor. The markets go up and down, so you have market risk as an investor on a variable annuity. And then maybe less tested but good to know from the investor perspective is credit risk. Is the insurance company stable? If they were to go insolvent, what happens to your annuity? That is credit risk. Less of a thing I think to worry about, but it does exist, so I just added it to my list of things to memorize. I know this is a long video. I told you it was a lot of stuff to memorize and get straight, but there is one more topic that we should cover relative to annuities to be thorough in prepping for taking a quiz or an exam on this particular topic, and that is understanding what a equity indexed annuity is. Yet another branch here on our tree of annuities. A equity indexed annuity shares characteristics of variable and fixed annuities. They provide returns linked to an equity index like the S&P 500. It may also be referred to as a fixed indexed annuity. Returns are guaranteed by the insurance company at some minimum level. It depends on the exact contract. And equity indexed annuities are not considered a security since the investors do not face investment or market risk. That ties into the second bullet point here. The returns are guaranteed. They're fixed. If it's a fixed annuity, the investor is not subject to market risk, and therefore it is not considered by the regulators as a security. There are a couple of key terms to remember relative to equity indexed annuities: the participation rate, the cap, and the spread. And I'll go through an example for each of these. The participation rate is the amount of the linked index return the investor is allowed to keep. For example, if the S&P went up 10% and you had a 70% participation rate in the contract, you would be able to keep 7% of that 10% performance on the S&P. The cap or the ceiling is the maximum return the investor may receive. no matter how well the linked index performed. For example, if the cap in our previous example was 6%, we would not be able to keep 7%. We had a cap of 6, so we only get to keep 6% in that instance if we had a cap in our contract. And the spread is a specified percentage deduction from the returns of the linked index. Remember that any one or a combination of these might apply to an EIA. Why might people pick these? There is one other key term to think about, and that is the minimum growth guarantee, also called the floor. And most EIAs include a floor of at least 0%, sometimes even higher than 0%, and that represents the minimum amount of growth guaranteed. A floor of 0% ensures that if the index that you're referencing had a bad year, you're not going to have a negative return on your EIA. You're going to stay at 0%. But if you had a higher floor, like 3%, then you're essentially guaranteed a consistent positive return. If you have a higher floor, though, it's often coupled with lower caps and lower participation rates and or higher spreads. There's no free lunch, right? For the Series 65 exam, assume a floor of 0% unless the question mentions a different number. The very last slide here talks about how do we measure the performance of this index when we're looking at a EIA. And there are 4 different ways to credit the performance of an equity index annuity: an annual reset, point-to-point, high watermark, and low watermark. Because this video is so long, I'm not going to read through all of these. I'm going to talk about the annual reset. At the anniversary date of the initial contract, the insurance company measures the difference 1 year later between the index value starting point from when you sign the contract to that annual measurement date, and they measure the difference between the index value at the starting point versus 1 year later. That is how you determine how the index performed. And then you compare that to your participation rate, your cap, and you might have a spread taken out. That is the simplest crediting method of how a index's performance is measured for your account. There is also point-to-point, high watermark, and low watermark. I think it's worth understanding that there are 4 of them and have a rough idea how they work. And so I am trying to commit these to memory myself, and I'll let you know after I take the exam if I had any questions on the EIA crediting methods or not. Remember, the test has a huge bank of questions, and everybody gets random questions. They're broken into buckets. And within each bucket, we never know what questions we're going to get. So we all get different questions. And some of your tests are going to be harder than others. That's just the luck of the draw. At any rate, thank you for hanging out. If you watched all the way through and you have other questions, be sure and leave me a comment below. I look forward to your questions and comments. Thank you for watching. I am Tony, and I will see you on the next video.